Okay, hey, welcome everybody. That title is Improving Your Trade Selection with myself. I'm Jay Norris. As always, before we get started, we need to point out that trading involves risk of loss and is not suitable for everybody. It's not suitable for all personalities. Some people, some people they're more planners than doers, and some people they're more doers than planners, and it's really definitely a mixture of that all that you wrap up to become a pretty good trader. We should say it's not suitable for all personality types. I think that would be more apropos. So we certainly mean that disclaimer. My name is Jay Norris. Thanks for coming. I'm a 20-year trading floor veteran from the Chicago Board of Trade. I've also written a couple of books on trading, which were published by McGraw-Hill, which serve as the textbooks for our courses. The text, there's the books. The tactic we're going to show you today is highlighted in this book on the right, Mastering Trade Selection and Management. And I'm also a professor at IBUniversity, where I spent a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. The methods we teach include both aspects of mechanical and behavioral inputs, and I think that's important to understand from the beginning, too, because so many people, they teach purely mechanical, a mechanical method, and then there's the other side of it where they're teaching purely behavioral. It's a mixture for us, and I think that's important to understand that. Before I cover how we can help your trade selection, a few words on methodology. The first thing you'll need if you expect to trade successfully is a robust trading method which works in all environments. It took us 4 years to put together a trading course that teaches an objective empirical method that you can use in all trading environments. So when I say trading environments, I mean up markets, down markets, sideways markets, regardless of shifting fundamental conditions, perhaps because of shifting fundamental conditions. So environment is pretty important to us, and that's where really the behavioral aspect of the behavioral input of what we do comes in. So if you're going to trade, you need a method for all seasons. And that method needs to be simple, or at the very least easily explained. I didn't say easy, I said simple. Trading is a simple process, being in the right place at the right time and clicking the mouse and then following your plan, pretty simple. It's never easy. Obviously, there's everything else going on between your ears, which doesn't have to be that way, but when you break it down, if we were to show you how mechanically we determine which market to trade and which direction to trade from, you'd say, yeah, that's pretty simple. And the trigger, which we're going to teach you today, pretty simple. Following through, all these things are relatively simple. It's just a matter of repetition, and it's also a matter of believing that the method works. So getting back to the method, I want to stay on point. The method has to be easily explained. For example, if I had to summarize the method that we teach at IBUniversity in 3 points, they would be: use pattern recognition to identify a market's growth pattern. When I say growth pattern, I mean, is that market growing or contracting? What's nice about a chart from a geometric standpoint is you could tell pretty simply, looking at the market, whether it's in fact growing or contracting, and that's going to be based on the pattern, that simple pattern of highs, isolated highs and isolated lows. And I'll show you specifically what we mean. So number one, to summarize the method, we use pattern recognition to identify a market's growth pattern. Number two, we use the scales of the growth pattern to identify buy and sell zones. Now, when I use the term scale or pattern, I'm referring to scalability. Scalability meaning the sum of the parts equals the whole. In fact, in trading, the parts themselves are scaled replications of the whole. When I say in trading, in market movement, when you study market movement so many times, those individual retracements are scales of the overall move. And, you see this throughout nature and everything natural pretty much, plants, etc. where the leaf is actually a scaled replication of the branch it's on, and the branch, of course, is a scaled replication of the tree, etc. So pretty simple. When we mean scales, we mean the parts themselves are scaled replications of the whole, and these scales, or retracements in the case of the market, determine, well, they give us buy and sell zones. So those are two very important points to summarize what we do. And thirdly, what we're going to cover today is we provide a fact-based trigger to enter and exit trades and show you how to use news and momentum to filter your trade selection, which is what we will be showing you today. So how can we help to improve your trade selection? That's why you signed up today. So let's see if we can accomplish that together. I learned a lot over the 4 years it took to put together the courses at IBUniversity, and the most important thing was knowing when direction is aligned with price pattern, because this determines when to enter a trade and when to exit a trade. Essentially, this is the trigger that we use. When we want to know at that point when direction is aligned with price pattern. For us, this is a fact-based trigger also. Direction for us is a fact-based occurrence. We could tell you at a certain point in time exactly what the direction is, exactly what the pattern is. And that point in time is generally going to be after the market has closed, generally on the close of a candle. That's important for us, and maybe we'll get to that today also. So know when direction is aligned with price pattern. Now, before we go any further, however, we need to break this down and define both price pattern and direction. If I'm going to tell you know when that direction is aligned with the price pattern, obviously you need to know what the price pattern is first, and you also know how to determine what direction is up or down. Let's cover price pattern first. Price pattern for us is the pattern created by a market's highs and lows over time. It's just a matter of marking the isolated high points and low points on the chart and identifying that market as exhibiting a bullish or bearish pattern over a specified length of time. Here we see a pattern of lower highs and a pattern of lower lows, i.e. a bearish pattern in the euro. And this is a current chart, so you're looking back over the last year or so. Well, it's not so current, I guess it's about a month late, but you can see you're still pretty much dominated by that same pattern currently. So right now we're looking at a little bit more than a year's worth of data, and it's pretty obvious that you have a bear pattern, right? You have a pattern of lower high, lower high, lower high, lower low, lower low. Pretty simple stuff. You always want to know that pattern. As a rule of thumb, if you want to know a primary pattern, pull up a year's worth of data, and that primary pattern shouldn't be able to hide from you. The primary pattern should pop out with a year's worth of data. So price pattern. Here's a bullish pattern, and you can see I've gone ahead and marked the higher lows on the bottom of the chart and the higher highs on the top of the chart. This is the U.S. stock market over the past few years, so it's important we can see this is a bull pattern. This is so important to us because price patterns, or more specifically growth patterns, are scalable, meaning the smaller price moves that you see on the left side of the chart are more oftentimes scaled replications of the larger price moves that you see now. So when price direction has shifted in line with that dominant pattern, that's the critical time you want to be in there. That's extremely relevant. Let me say that again. When direction shifts in line with the overall pattern right there, you see the green circle right there, you see the green circle. That's a shift in direction in line with the pattern. That's critical. That's where we want to be. An even more simplified way to look at this would say that we're buying dips in an uptrend. So we're buying dips in an uptrend. Keep it simple. Scalability, a word on this. It's important to understand it because it's easy to overlook basic patterns, especially if you're focusing on technical indicators or crowding your charts, with other indicators or overlays. But if you know to recognize those higher time frame patterns, There we see the higher time frame pattern. It becomes much easier to understand and even expect these same patterns in smaller scale on the lower time frames. If you look at the middle of the chart, middle right of the chart, you're seeing scaled replications of that overall pattern. Pretty common in trading. The really good news here is not that markets typify fractal geometry, though that is good news, but that we as individuals are naturally very good at pattern recognition. In fact, one of the things that we're still better at than a computer is simple pattern recognition. While each pattern a market creates is wholly unique, it is generally just a slight variance from previous patterns. That slight variance doesn't mean much to you and I. We recognize the pattern easily, but it throws off the computer, which only knows to look for what's programmed into it. Now, this is why Wall Street doesn't make its money from betting on which way a market is going to go over time, but they make their money from taking the other side of our trades, i.e. making markets, and of course from getting paid a transaction cost, also known as a commission. So you actually have a leg up as an individual because we're pre-programmed to be pretty good at pattern recognition. Individuals who let the computer literally get in the way by putting all kinds of indicators and overlays on the chart, they're going to overlook some basic stuff that's going to help you as a trader. A word on scalability and repetition, both very important. Repetition is a great thing. I love it when a market just continues to do the same thing over and over again as they do so often. Along with being scalable, you know, that's being repetitive too. And the study of this phenomenon of scalability and repetition is called fractal geometry. Once a growth curve is established, be it positive or in the case of this market, negative, it tends to be repetitive, as we can see in this Aussie dollar chart. It's what we call a negative growth pattern. Now, a word on what creates that negative growth pattern. You're obviously in an environment that's supportive of a negative growth pattern. What was really interesting about the Aussie, to me, which is a market I follow closely, we started seeing bad numbers coming out of Australia very early in the year, January and February, yet that market kept going higher. So, hey, the pattern was still bullish, even though the fundamentals were starting to come out bearish. Once that pattern topped out, then we saw the market rolling over here, and it rolled over in February, and now you can see from March into February, you've had a negative growth pattern. Well, once the pattern is in line with that, or I should say once the fundamentals are supporting the pattern, then you have a powerful thing going on. That's when you get that repetition. So, you know, it's a funny kind of thing. What came first, the chicken or the egg? But if you see a bearish pattern on the chart, inevitably you're going to have supporting fundamentals. In fact, we could say that the scale on the chart is actually a reflection of what's going on in the environment, i.e. what's going on fundamentally in the market. So you'll never hear us, say at IBUniversity, you'll never hear us talk about technicals versus fundamentals. Essentially, they're one and the same. The chart's a reflection of the fundamentals. I think if you have a sound understanding of pattern first, i.e. whether a market's in a balanced state, which is a counter-trending state, or in an unbalanced state, which is a trending state, you're going to have a much easier time interpreting fundamental news. It's going to make a lot more sense to you once you're aware of what the fundamentals are saying to you. I should say, once you understand that pattern, everything else is going to make a lot more sense to you, because it's amazing how markets react differently to news when they're in a balanced or unbalanced state. Egg came first, Philip says. Fish eggs. Very good, sir. Very good. I believe that. The egg must have come first. Something to do with water, right? So scalability and repetition, they're great things in trading, and they're there to help you simplify it. And believe me, that's what you want to do, simplify it so you can just be there at the time the market sets up, get in the trade, put the stop in, manage the trade, walk away, go walk to the park. You don't have to stay glued to that screen, but you want to learn how to manage that trade properly. And once you learn simple tactics to do that, and that you can verify them for yourself over time, that's going to be a big help to you. Scalability and repetition are really your best friends as a trader. Once again, that critical point for us as traders is when direction shifts in line with the price pattern. This occurrence we've highlighted here with these red signals, red circles, is called a change of direction. An even more simple way to look at this is what we're looking for is really selling rallies in a downtrend. Getting back to keeping my whole point of keeping it simple. Well, I just explained to you essentially geometrically what you see. Very simply, you're selling rallies in a downtrend. What we highlighted at that point, which is so important to us, where direction shifted in line with the pattern. So we showed you what the pattern is. Now we need to show you, we need to cover what the direction is. And keep in mind, it's always that same point we're looking for in upper and down markets. We want to know when direction shifts in line with the pattern. Here the pattern, pretty simple, is down. So we're looking for bearish change of direction candles. And I was looking at the chat box. I'm with you guys. We have a philosophical crowd today. That's good. I'm very comfortable with that. I can't argue with any of those questions or statements on there. So back to the technical analysis. It's really when direction shifts in line with that price pattern that we're all about. And keep it an even more simple way to look at it is we're looking for when direction, we're looking to sell rallies in a downtrend. It's that simple. You're looking to sell rallies in a downtrend or buy dips in an uptrend. So as humans, getting back to that point, we're pretty good at pattern recognition to start, and it's that change of direction in line with that pattern that we need to focus on. So I think you're all familiar with the price pattern. Let's define change of direction. I want you to take a good look at what occurred here also when this trend line gave way, because this is another, you had a bullish pattern, didn't you? Once that bullish pattern gave way, you broke down, you had one more rally back. This is why we love selling rallies in a downtrend. Even before you had this rally back, what happened? You had a pattern of lower highs. So the rally back created another lower high direction change in line with the new pattern. And that's how that goes. So you want to know that all-important point when direction shifts in line with the pattern. You'll remember that because we'll go over an example of that too. Michael, I'll cover that when we get to the live chart. Well, in a nutshell, you're going to draw trend lines from the wicks in a trending market and from the bodies in a counter-trending market. And I'm glad, somebody brought that up last. That was exciting when someone asked me that last week, and I was like, oh boy, you guys know your business here. Pretty smart to ask that. But hey, let's define change of direction first. This is how we determine direction, trend line break plus a directional line shift. So a change of direction, this is important for us. This is the trigger. This is how you know when to get in. It's a trend line break plus a directional line shift. For today's demonstration, we're pretty much going with wick-to-wick trend lines, which indicate trend line as opposed to a counter trend line, which would be the body-to-body. So change direction, trend line break plus directional line shift. Directional line defined, the low of the highest closing candle in an uptrend and the high of the lowest closing candle in a downtrend. Well, take a moment and write this down. We're big on having things simplified here, and sometimes our brains, after it depends on our experience, our brains just aren't ready for simple things because we're so keyed up and we're so used to thinking things are complicated that it's kind of hard to grasp a simple thing. I certainly understand that. That's why I want you to write this down. The low of the highest closing candle in an uptrend and the high of the lowest closing candle in a downtrend. Now, once you've written this down, once you've memorized this definition and then started to demonstrate it for yourself, you'll start to appreciate it. Now, take the first one, the low of the highest closing candle in an uptrend. I want you to close your eyes and imagine an uptrend. Imagine an uptrend at least 5 candles, at least three to four of them are green candles, right? So you're in an uptrend. You're looking at 3 to 4 green candles. Now, I want you to notice the highest closing candle, not the highest candle, the highest closing candle, meaning price had to close at the highest point at that point. That's a significant candle. Now focus on the low of that highest closing candle. So you're looking at the 5 or 6 candles, 3, 4, 5 of them are green candles. You're looking at the highest closing candle, not the highest candle, the highest closing candle. Then focus on the low of that highest closing candle. That's going to be a significant point in time and price, because at that point in time, that's when the market was the strongest on a closing basis. Factually, that market was at its strongest point of that trend on a closing basis. That's a significant event. Now focus on the low of that highest closing candle. That's pretty significant to you. So the low of that highest closing candle is going to be a significant area. Take my word for that. Now, same thing, same exercise. Look at the high of the lowest closing candle in a downtrend. So you're looking at a group of candles all rolling lower. You're looking, close your eyes, see 4 or 5 red candles. No, focus on the lowest closing candle, and then mark that high, because that high and that lowest closing candle is going to be a significant level for you in determining that change of direction. Okay, good. Hopefully you guys wrote that down and you visualized it. I find making you guys visualize it is going to be a lot easier to understand. It's one of those simple things that's just you don't see right away. Hey, believe me, it took me a few times of saying the low of the highest closing candle in an uptrend before I was comfortable spitting it out. Likewise, the high of the lowest closing candle in a downtrend. And we'll show it to you on the chart too, make it a little bit easier for you. And here we would demonstrate that point. There it is. Price reversal equals the trend line shift plus directional line shift. We highlighted on the bottom. That's what you're looking for. That's important to you because you want to know when the market reverses, right? So price reversal equals a trend line shift plus a directional line shift. We've gone ahead and highlighted the 2 instances for you. There's actually a bearish shift there. That was your highest closing candle in an uptrend. See, there's the highest closing candle. You mark the low of that. Once price closes below that, you have a shift, right? So that's a directional line shift, and plus the trend line shift. So you have a trend line shift plus a directional line shift. That's an important occurrence for us. Now, it's very simple. Once price is below the line, the direction is down. As long as price is above that line, price is up. Well, put it this way. As long as price is above the trend line and the low of the highest closing candle, the trend is up. Once price is below that line and below the trend line, price is down. Now we're going to start marking the high of the lowest closing candle on the way down. We'll show you that on the chart too, but this is just a demonstration. You can see we've highlighted there's a shift and there's a shift, and both those occurrences happen at that point. So that's a pretty important occurrence for us, pretty important trigger for us. Also keep in mind that there is only one directional line per time frame. But there are different directional lines for different time frames. For example, we would have the weekly directional line. You have a monthly directional line. You have a daily directional line. And we're going to demonstrate the 4-hour directional line for you. This chart's a weekly chart, so this would be a weekly directional line. And if you want to know more about this, there's a whole chapter on it in that book we highlighted, Mastering Trade Selection and Management. Probably do a better job in the book explaining it. But that's your change of direction. That's your reversal. And there, chapter 3 of the book, if you want to see a little bit more about that. Definitely a little bit more in-depth discussion on it. You know, the easiest way to demonstrate this tactic for you is go to the chart, which is what we're going to do. Let me reset my camera here. Okay, hopefully everyone is seeing the chart now. You're seeing a chart of the Australian yen. Okay, very good. Ideally, everyone's looking at the Aussie yen. It's a 4-hour chart. You can see I marked. You can see there's a trend line. Hey, let's go all the way back and show you where that trend line came from. We did the same exercise last week with the Aussie. I love the Aussie pairs. It's got that big fat yield. It's a great trading vehicle. Any market that's got a fat yield like that, you're going to ensure that you have players in there. You're going to have institutional money in there, so it's a good market to trade both sides of. I love a market that has two-way trade. And the Aussie pairs do. And here's the Aussie yen. The reason we're highlighting this area at the beginning of the previous month, April, is that, look, you took out a long-term trend line. I'm always interested in that because the trend line itself was telling me that I had a pattern of higher highs and higher lows. I was in a bull phase. Love a bull phase. Love buying dips in a bull market. Well, what happens when that trend line breaks down? It's simply telling me, hey, the pattern is shifting. We went from having a pattern of higher highs and higher lows. Now we have a clear pattern of lower highs and lower lows. So that's why I came on the chart right here. Now let's demonstrate that. We'll demonstrate the directional line for you. See that teal colored line right there? That's my directional line. What that line does is it marks the low of the highest closing candle in an uptrend, and it marks the high of the lowest closing candle in a downtrend. Let me demonstrate this for you. Okay, right there, see this uptrend we were just in? That's the highest closing candle in the uptrend. As long as price is closing above this line, the short-term direction is up. Once it closes below the line like it did there, direction's down. Okay? So whichever currently direction is down. We could say direction is down because it's below the line. Now, even though direction is down here, we're really not interested in that because the pattern is still bullish, right? We still have a pretty bullish pattern. You could see that pattern. So I'm not interested in a change of direction south. I'm not interested in a sell signal in an uptrend. I'm not interested in a sell signal because the price pattern is bullish. See how price stays below that? As long as price is below that line, then the short-term trend is down. Direction's down. Okay, right there. See that? That's a buy signal. Okay, why? Because you had both a change of direction and a trend line break. So I would probably be interested in this as a buy signal. If, put the stop in, manage the trade, okay. Now just guess what happened right there. Bam, you shifted south. So that would be a signal to exit any long trades. You're not going to go short because the pattern's still up, but when you get a change of direction south like that, see, once I hit the button next, we go from marking that low of the highest closing candle to marking the high. We go from marking the low of the highest closing candle right there to marking the high of the new low closing candle. Now is when I really get interested in this thing because direction's down and the pattern is shifting down also. So this is great. This is essentially what we look for. Moss asked about the MACD. Well, I'm going to get to the MACD momentarily. The MACD is how we gauge momentum. And remember back in the PowerPoint, I put out three simple points on how I would explain the method. And I said within that method, we're going to show you how to measure a change of direction, how to use that in the context of momentum also. So we're very much interested in this market now because the pattern is bearish. So with a bearish pattern, we'd be looking for a bearish change of direction. So yeah, you had one right there actually. See how you were in the uptrend and we were marking the low of the highest closing candle in the uptrend? So right there, bam, you had everything shifted south. Now we're still not quite sure of the pattern. You're still on that trend line. I'd much rather sell a rally in a downtrend. So I'm not going to jump in on the breakout itself. I'm a patient trader. I'll let that market rally back. I'll look for, along the lines of what we're getting now. See how you had a breakdown, then a rally back, then a breakdown, a rally back. Each time you're putting in lower highs, by the way, and that tipped us off that was confirming the pattern also. So now I'm pretty confident that I want to sell rallies, right? So I've got to wait for a change of direction and a trend line break. And I also want to have the support of momentum. If momentum is up, as measured by that MACD, I'm not interested in sell signals. There you have it. You have a trend line break and a change of direction right there. See how price closed below that low, the highest closing candle. So there's a change of direction south. We could very definitely take that. We could take that as a sell signal. Tell you what, generally I like to see two MACD histograms down. In this case, you only have one down, but you have that blue line coming back down. Well, let's play it by the book. I'm not going to take it just yet because I want to have two MACD histograms ticking in my favor. So I'll hold off. All right, now I have it. See, I have two. I have a shift in momentum. So that will be my sell signal right there. And momentum is in line with that. If I'm not using the MACD, guys, if I don't use the MACD, I can just take a straight signal off a trend line break and a change of direction right there. But I'm going to use that MACD because I'm going to tell you momentum is a great thing. Momentum comes about, momentum so many times is based on fundamental news. And that's why it's critical for us. So that's my sell signal there. I went too fast. So you'd be in here, and you'd probably want to come out there, right? Because direction changed right back, right? Now, we're not going to take that as that's a buy signal. We could use that to exit shorts. We could exit a short because we had a trend line. You had a trend line break. Let me draw that. And you had to change of direction. I really hope I'm not talking too fast. I hope you guys understand what a change of direction is. It's you take the high of the lowest closing candle. Like here's a downtrend, red, 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 red. You have, 6 candles down, 4 of them are red, and then you close above the high of the lowest closing candle. That's a change of direction. Now that's a counter trend buy signal is what it is. Now, I'm not interested in a counter trend buy signal. I'm only interested in sell signals. Why? Because the pattern is bearish. If I were to mark these highs for you, you'd see lower high, lower high, lower high, lower high. So I'm only interested in sell signals and lower high. So what's another way to simplify this? Hey, I'm looking to sell rallies in a downtrend. So while I have a counter trend buy signal here, I'm not interested in going long, but I could use that to exit my short. So I can exit, I could take a profit on that short, and I could sit tight. And now I can start cheerleading the rally, even though we have a bearish pattern overall. Now guess what? We're hoping this market goes up. We want to see this market go up because the higher it goes, the lower the risk on the trade. Huge. I hope I pronounced your name right. Shuaige. Shuj. He asks, when would you confirm market confirm change? When does the market confirm changing direction? Remember on the slide we said when you have a change of direction, when you have a trend line break, plus when you close below the low of the highest closing candle. This is my highest closing candle, and I'll move that line up. See, that line marks it for me. It's automated. It actually updates a candle too late. It updates on the opening of the next candle. So every time you get a new high closing candle, that directional line is going to move higher with price. Every time you get a new high close, the line is going to move higher. If the only way the line can switch is if you close below the line. You either get two ways the line can move. You get a higher closing candle, in which case the line paints the low of that candle, or you close below that line, and then we go from painting the low of the highest closing candle. Now we're going to paint the high of the new low closing candle. Once price closes below that line, it can trade below it, but it has to close below it. Once it closes below it, that and the trend line, that constitutes a reversal. That's what we call a change of direction. So there's your trend line, and there's your the low of the highest closing candle right there. So we know not to go short. Even though the pattern's bearish, we know not to go short. So we're waiting for that occurrence. Well, there you go. You have close below the trend line. You have a change of direction, bearish change of direction, absolutely. So you have our conditions and momentum. Look, you have a downtick here on the. You have a downtick in the way of the MACD. Now, if you want to wait for a second downtick, let's stick with the method. We want to see two. We want to see 2 histograms downtick. You can wait. So you can take it here off the strength of price, or you can take it here with the confirmation that momentum has in fact shifted. Now, something happened in there to shift that momentum. Suj had a question. How would you confirm? How Solomon saying how does momentum from MACD come from fundamentals? That's a whole nother lesson right there. No, Boyke, great question. Do you mean trend and direction at the same time? No, direction is separate from trend. The trend is still higher right here. The short-term pattern we can substitute for trend. The trend is higher, but the direction has changed. But the pattern is bearish. Got it? So that's a great question, Boyke. Trend is not direction. They're separate. Direction is short term. The trend is going to be intermediate to long term. So this is very definitely a sell signal for us because the overall pattern is bearish, the long-term pattern is bearish, and you have a change of direction in line with that pattern, and you had a trend line break. So we're going short there. Now, you actually changed direction higher right there, didn't you? Well, if you're short here and you have a stop up there, you're either gonna, exit. I wouldn't even suggest exiting the trade. I'd just stick with the stop. Stick with where the stop is. You technically had to change direction there. You can exit that. You can exit right there because price closed above. See the line shifted? The line went from. See that line's on the high of that candle. Now it's on the high of the next low closing candle. Now you close above that line. Technically, that's a shift, a bullish change of direction. But you're already short. You already have your stop in place. Me, I'm probably going to stay short. Or you can exit the trade, take a small loss, and wait for your next change of direction candle south. And right there's another sell signal. I'd probably still be short from here. But if not, if you went here, short here, and exited there, you're going to take a short here, right? Because you're closing below that directional line, that low of the highest closing candle. If you want to draw a new trend line, you sure can. Your new trend line, something like that. So that's a sell signal there. And there you go. You change direction right away. This is how markets move. I mean, they flip around. So you're either short from here or from here, and then you get the change right there. So once you see that once you close above that trend line, you're not going to go long, but you're going to give serious consideration to exiting that short trade right there. And as I said, you'd be out there anyway. I don't think you shifted direction. Oh, you may have shifted south in there. But you guys get the point where you're basically just waiting for a change of direction. You're waiting for, you're looking to sell rallies in a downtrend. So you're looking for that change of direction. You're looking for a change of direction in line with the pattern. So here's a bullish change of direction. Really not interested in that because you're not interested in that because it's in line with the, it's counter to. That's a counter trend line, counter shift right there. So hopefully you guys are following me. I see I have a lot of questions. A question on stops, 1 pip plus spread enough on a stop market timer? Oh, a stop. I generally want to put a stop 6 ticks behind the last isolated low. Depends. As a day trader, 6 pips. As a position trader, 11 pips to maybe 16 pips. You got to give that stop plenty of room there. So here's a buy signal. We're not interested in going long. We're only interested in sell signals. So here's what's fun about this. And we're only interested in sell signals because you can see clearly you have a pattern of lower highs overall. So here's what's fun about it. Everyone else is howling that the market should be going short, especially in the euro. People, they get mad when the euro rallies, even though it's in a downtrend. They think it's going to go straight down. Here's what's fun about this. Right now, we're cheerleading the rally. We want to see this rally go as high as it can because, hey, we want to sell rallies in a downtrend. Sometimes I feel somewhat handicapped when I'm demonstrating this because, our students at Trading University, who we certainly appreciate them and they appreciate us. And we spend a lot of time with them teaching in live markets. Our master's course is 64 hours in live markets taught in both the U.S. session and the Asian sessions. And I guess my point being I'm kind of handicapped when I'm demonstrating here for you guys because I can't just come right out and give you guys everything, right? I mean, I can't teach you the whole method that took us many, many years to learn, and all, our clients have pay for that method. But I do feel somewhat handicapped, so I'm going to give you a little something for nothing. I'm going to explain to you the importance of price pattern by demonstrating it. I'm sure you guys have heard of a 50% retracement, right? 50% retracement. It's so important in both Fibonacci, in Gann, in Dow theory. 50% very, very important to us, right? So I'm going to give you a tip. I'm going to cheat here. I'm going to take something away from price pattern that we teach at those higher levels, and I'm going to take this high here. Now, the reason I'm selecting this high is because it's a new month, right? That's a new month. It's something special when a week ends or a month ends. You tend to get a different perspective on things. So I'm going to take this high because it's a new month, and I'm going to go to that low, and I'm going to mark the 50% retracement line on there. And this trick is as old as the hills. It's as old as that other old gray-haired guy I see on here. And I'm probably older than him, though. I probably just look better, though, right? I'm joking. Here's the 50% line. Old trick to use. I'm going to mark that 50% line, the purple line there. And I'm going to key off of that as resistance. I understand that that's a 50% line. And this is one of the edges we teach. A lot of times, markets, when they go sideways, all they're doing is they keep hitting up against that 50% or maybe a 618%. They're just hitting up against obvious resistance there. So we're interested in, we definitely would be interested in taking sell signals against that 50% level. So we know ahead of time that that's a level that we want to get short from. We know that's good resistance. And I'll be real patient, too. If you take a sell signal against that level, you want to put that stop above that high, right? Here be the high point at 84.80. So I'll put my stop at like 84.86 just to make sure my stop is behind that. You guys asked about a stop? So there you go. I'm not as old as you guys. I'll tell you a good story. My buddy, long-time EDF Man employee. You guys familiar with the brokerage firm EDF Man? I worked for them before. They happened to go out of business, right? Well, my buddy had worked with them for forever, and he's an old guy. And luckily, he was at that age where he could go on Social Security. He said, Jay, the first time in my life, I'm actually happy that I'm 10 years older than I am. Because, hey, let's face it, you're an old guy. You work for EDF Man for 30 years. That's all you know. Kind of hard to go out on your own then, right? Anyway, it's okay to joke about old guys. I'm old now. But one good thing I like about having gray hair is I could speed, too. And if the cops pull me over, they take one look at me and they go, like, you're a senile old man. Just go home, okay? Go home, old man. They don't want to write me a ticket. But back to the method, I cheated there. Now, I used the 50% level because that's old as the hills. You know, that's in Gann, that's in Elliott, and certainly Dow theory. So 50%, I'm cheating. That's going to leave me real patient, too, right? Because I've got to stop behind here. I'll take every sell signal. I'll take two. I'll go short two and cover. If I get 20, 25 pips, I'll take one off at a profit, and I'll maintain my short position because I got to stop behind that isolated high there. So I love it when I see 50% level holding because that's going to give me what we call a scalp line. I'm going to get a nice scalp line. I could day trade against it, and I know overall that I'm trying to catch a big one. Bam, there it is. So you want to take your short. If you're not short here with a stop behind that or here with a stop behind that, you definitely want to get short now. And you can put that stop same place. Now you're short. Now look at how the 50% level provided pretty good resistance for us. Now you're starting to put it together. That's price pattern. George of the VA. No. Well, you need to bring your oxygen supply with you. And you go, officer, my oxygen supply here is getting low. Can you give me a pass? So that's definitely the area of the chart where you want to get short from. And when you see, here's a trick too. When you're breaking down like that, technically you can see you have a change of direction right there. Just barely. Now, in the book, we teach you that when you have little candles like this and they're at off hours of the day, that we don't count them. You don't take a change of direction off a really tiny candle. Your best change of directions are going to come off of longer candles. So in this case, technically you're getting a counter trend change direction here, but look at momentum. Momentum is straight down. The market's straight down. I may not want to come out of my trade there. I could put my stop at a break even. Heck, I'm short. Remember, I'm short from up here. I'm more short from up here. I'm patient. I am patient too. When I see a setup like that, the risk is not taking a small loss. The risk is missing a big move. So I don't want to miss that big move. Plus, I'm already sniffing this out. I'm sniffing that out. What if that breaks down, right? So I'm doing everything I can to stay short here in my mind because I want that big move. Well, I better have come out at some point here. Well, here I'd get hit with the break-even stop right there. Boy, look at how that turned around in a hurry on us, huh? Now, here's the interesting part. You're still below that resistance. So here I'm back to cheerleading a rally. I didn't take a profit quick enough. It looked like I would have been stopped out break-even right there. But I'm right back into that. I'm right back to that same resistance levels. Boki, the book is the textbook for the course. It's essential. I could tell you what you learn. You trade off from the tip of the iceberg. It's so simple. You have a few things that you're just focusing on, but it's amazing the amount of information that you have to get into that iceberg to get to that point. The book is essential. Here's another change of direction. Another bearish change of direction. Oh, you know what? We're running out of time. I wanted to show you guys some examples of how this would have worked on the non-farm payroll number. Here, let me see if I can switch over quickly. The fourth. I just switched to a 15-minute chart here. I wanted to show you something really quick before we wrap it up. Here's your non-farm payroll number on Friday. Now, what's fascinating about this is it was a bearish number. There was no doubt about it. You already had a pattern of lower highs. So you had lower highs, you had lower lows. When you see a bearish pattern like that, do not hesitate. Get in that trade. Here's the number itself. You may go down to a 3-minute chart. Just because the market hesitates, you don't. That market was already exhibiting a bearish pattern. The number was bearish, no doubt about it. You had a knee-jerk higher. So once you take out that trend line, this is the non-farm payroll, have that trend line in place. Once you get a change of direction back lower, you got to get on that side of the market because this is a perfect storm. You had a change of direction in line with a bearish pattern, and it was a bearish number. So your overall environment was bearish already. So it was just brilliant. Okay, let me switch screens here one more time. Okay. Hey, thanks everyone. I see a couple more questions. Let me see if I can get back to those. But if you want to know, more of what we're doing and you want to get it for free, you can go to our site, IBUniversity, and I think this panel will have been changed. This is actually where I have to go later today, downtown Chicago, to sign a book. But I think if you just click this box, right, you just click on Core Concepts. Go to IBUniversity, click on Core Concepts, and we got a free course for you. You can go in there, and I think it's probably several hours of it, too, of our core concepts. Good stuff, essential base to learn as a trader. George of the VA saying, do you readjust your time frame perspective when the price pattern trades in the sideways to see if the momentum? Yes, absolutely. To see if the momentum is still biased to the downside. Yeah, I don't, generally momentum, a pattern's not going to change. For instance, I'm really bearish right now on the euro, on the Aussie, on the U.S. stock market, very bullish on the Canadian dollar, on the Swissy, because that pattern's not going to change. It's the patterns don't change. So when you have an unbalanced market like we're in now, that's the time to make hay. That's the time to pull all-nighters. Generally, if a market's balanced, I'm just sitting tight. I'm just like a spider in the web. I'm just waiting for something to happen. It doesn't happen too often where I'm like gung-ho opinionated. And I'm not opinionated. The way we measure markets is mechanical. So my method is telling me that mechanically, the trend is down. Alan, does your book elaborate more about? Yeah, the book is great. The book is great. Sometimes I pick up that book and I read it and I go, man, I wrote this. It was a ton of work. I don't ever think I'll write a book again. I did 2, and that was about it. But no, the book is great. Yeah, much of this is in the book. I'll tell you guys, what's going to make you good as a trader is you have to believe the method that you follow. You have to understand why it works. You have to see it work many, many times. It's really a philosophy. It's philosophical. You have to understand why it works. You have to believe in it. Once you get to that point, then, man, trading is beautiful. It's beautiful. Hey, Boki, thank you, sir. Hey, everybody, thank you very much. Pick up, get our free core concepts course from us at IBUniversity, and we look forward to seeing you next time. We look forward to seeing you in our live market exercises also. Boki's asking about which books here. Let me go back in time here. Oh, there we go. Mastery, Trade Selection, and Management. Good one. Hey, like it. Thank you very much. Hey, thank you, Vicky. See everyone later.